What is up, you guys? Nick here, and in today's video, I'm going to be discussing the fascinating electric vehicle company XPeng based out of China. Like many electric vehicle companies, the past few weeks have granted XPeng an absolutely massive surge in share price. I want to discuss why this is, if there will be an ensuing correction, if you should buy now or wait, and what investors can expect from this dynamic and forward-thinking company in the coming weeks, months, quarters, and years. If you haven't already, hit that subscribe button. I do a ton of videos like this focusing on EV, tech, IPOs, and disruptor companies poised to make massive gains and shape the future landscape. I first told my subscribers to purchase XPeng shares at $19.62 a share, which is now over a 100% position. You don't want to miss any future picks. While you're down there clicking things, smash that like button for the YouTube algorithm. I would really appreciate it. And without further ado, let's get right into it. Alright, so XPeng is currently sitting at $41.99 after a 6.13% hit on Friday and is also in the red after hours. It is important to note that it's up over 18% over the course of the past 5 trading periods. So should you buy after the surge? Have you missed the boat? Well, to decide, we need to do a little analysis to see where their share price could reach. A lot of people have been asking me lately whether they should invest in a single EV company or broaden their exposure to multiple EV companies, and this is absolutely a no-brainer for me. Diversification is absolutely always key to a successful portfolio. Spread your eggs into many baskets to ensure you are hedged against losses and to increase your chance of big wins. Diversification smooths out your gains, so yes, I am personally invested in many EV companies and will be releasing a video in the coming days of my top EV picks moving forward. Many people have been comparing XPeng and NIO, however, these companies virtually could not be more different. The only things they share is that their share prices are beginning to mimic one another. However, this is essentially baseless. And second, they are young Chinese electric vehicle companies. Unlike NIO, XPeng actually manufactures and designs in-house, and this is a really big draw for many investors, me included. You may be aware that NIO outsources their entire manufacturing processes to JAC. However, very early on in XPeng's business life, they realized that becoming a vertically integrated company could be crucial for their bottom line and their margins. Although a bigger hit in cost and revenue, R&D, and operating expenses up front, vertically integrated companies are poised to make more rapid increases in their margins once the infrastructure and facility are up and running by not having to pay out a certain percentage for manufacturing purposes. XPeng, being an incredibly young company, is actually dominating their deliveries. They were able to deliver 3,040 vehicles in just the month of October alone, representing a 229% year-over-year increase. These are much better year-over-year increases than rival companies like NIO are posting. However, they are at an earlier stage in development, therefore it's much more attainable to hit these plus 200 percentage point gains at this stage. They had in fact delivered less vehicles in October than they did in September, 3,487, but it is important to realize China's Golden Week would have seriously impacted their delivery capacity, so don't fear slowing growth. They, like many other EV companies, have incredibly high market caps. XPeng is currently hovering just north of 30 billion. They have an average earnings per share estimate on their current year of negative 0.79 and an average earnings estimate of negative 0.43 for the calendar year of 2021. This is showing that analysts are very bullish on XPeng's potential movement throughout the year and do expect them to continue increasing their margins, lowering their cost of revenue and their operating expenses. These margins are actually increasing at faster paces than NIO, which may be due to the fact that they are indeed vertically integrated. Another factor I found extremely enticing and interesting when deciding whether to invest additional capital in this company is that analysts are predicting an over 100% increase in total revenue for 2021. XPeng currently has an estimated $2 billion total revenue average consensus for 2021, compared to the only $766.96 million for the current year. This is highlighting the extreme bullish outlook on the electric vehicle industry within China as a whole and the already extreme consumer interest in XPeng. There is a total growth estimate set for the next year at a whopping 45.60%, which is just truly incredible. There is so much hype and promise within this electric vehicle Chinese community right now, and analysts and investors alike are jumping all over these companies. One of my favorite components of XPeng's business operations is their calculated intention to design sedans that are both incredibly affordable, sleek and silky, and also fully electric. This is almost an impossible feat that they have made possible, and I see so much promise with this vehicle. XPeng's P7 is one of my favorite electric vehicle sedans currently on the entire global market and is poised to rival Tesla's Model 3's domination in the Chinese market. There is a current trend forming in mainland China to smaller luxury electric vehicles, and XPeng's P7 is perfectly situated for this growing trend. The bulk quantity of deliveries consisted of the P7, 2,104, in comparison to their larger compact SUV, the G3, which only delivered 936. The P7 is poised to continue dominating into the historical surge of auto deliveries that occurs in Q4 within China. XPeng continues to grow at a rapid pace, and the fact that they apply to a larger market share than NIO, having much less expensive vehicles, may be able to grant them a nice foothold in the affordable electric vehicle market in China. The health situation may have negatively impacted many consumers' discretionary income, and it may become increasingly beneficial to be an electric vehicle company in the affordable pay grade market. The Chinese government has imposed legislation requiring that 25% of all vehicles produced by the year 2025 must be electric. This is incredibly important for electric vehicle companies in that there will be government backing, subsidies, and incentives for companies to produce green electric affordable vehicles. When investing, it's important not to just look at the short-term trends and analysis, but realize the benefits and promise of these companies at least 3 to 5 years out. Electric is the future, and these early, young companies may indeed be the future backbones of this fascinating industry. Alright, to the price predictions set for 2021. Unlike Chinese competitors, XPeng's 2021 price prediction is actually much more narrow, with a smaller delta, showing an increased confidence interval and certainty with their share price targets. I think a lot of this stems from the fact that they are indeed vertically integrated, have an increased capacity on their manufacturing, therefore supply strain isn't a concern, and a very predictable steady increase in delivery figures is making it easier for investors to allot capital to their company. There are far fewer uncertainties with this company than other electric vehicle companies, and the fact that they are not positioned directly in the luxury electric vehicle market per se also bodes extremely well for investors' peace of mind given the current health situation and economic uncertainties moving into 2021. We see an absolutely massive high-end price target of $331 for the next 12 months out, representing a whopping 693.3% increase. This is actually a bigger percentage spread than competitors such as NIO. We see a median target of 248 representing a 495% increase and a low of 150 representing a 260% increase. Analysts are clearly extremely bullish on this company, and considering analysts place NIO's low-end share price at roughly their current share price, whereas they place XPeng's low-end share price up 250% from their current share price, shows that with less uncertainty in a business model and a more transparent future, there may be less risk and more upside associated with XPeng than competitors. But like I said before, in by no way, shape, or form do I think that diversifying amongst many EV companies is a bad investment strategy. It's currently what I am personally doing. I love the fact that they are rapidly expanding and constructing additional factories to increase their capacity before reaching these outputs, therefore completely avoiding supply strain and ensuring that their supply can meet demand. They are currently building a second mega factory to begin mass production in 2022. If we do see dip days in their share price, I will be continually picking up additional shares as I see huge things for this share price 3, 5, 10 years down the line. I am not worried at all about these short-term fluctuations and short-term insight or short sellers, as I am strictly a long-term investor. It's clear that electric is the way of the future, and both analysts, investors, and companies are realizing this. I will have additional videos in the coming days and weeks about this stock and company. They are one of my favorite electric vehicle stocks, and I will be keeping a very close eye on them in the coming days, weeks, and months to help keep all of my subscribers and viewers informed. Anyways, everyone, thanks so much for watching. I really do appreciate it. Hit that subscribe button if you haven't already. Thank you for the continued support. See you all in the next video. Cheers.